Ladies and gentlemen, a very good afternoon to you all from Dhaka, Bangladesh. I know some of you are traveling and are in different parts of the world. So wherever it is morning, good morning. Wherever it's evening, good evening. Um, and a very warm welcome to this webinar of ours. Today, we will have Mr. Asif Khan, CFA, founding partner of Edge Asset Management and Research, Research and Consulting Limited, delivering the presentation on macroeconomic outlook of Bangladesh. Before I invite Asif to deliver his address, I would kindly like to request our President, Ms. Tarin Aman, to kindly deliver the welcome address. Tarin, over to you.
Thank you, Mashur. Dear members and stakeholders, greetings from the Nordic Chamber of Commerce and Industry in Bangladesh. I would like to welcome you all to the webinar titled Macroeconomic Outlook of Bangladesh, presented by Asif Khan, CFA founding partner of Edge Asset Management, followed by Q&A session. As you're already aware, the Honorable Finance Minister, Mustafa Kamal, placed the national budget for the fiscal year 2021-22 at the Parliament. The government targets for 8.2% GDP growth with 5.4% inflation. It is of utmost importance that we follow the macroeconomic trends and market movements, especially now during the pandemic, in order to forecast and plan business activities. This is particularly important due to the prevailing conditions and the adverse effect that the pandemic has caused to the economy. Prior to the economy being hit by the COVID-19 crisis, we have noticed negative import and export growth, low FDI growth, subdued domestic resource mobilization, low utilization of allocated development expenditure, and weak balance of payment situation. The ongoing pandemic has aggravated the dismal performance of the economy in the recent year. It is not only Bangladesh which has been hit in the recent times, but the pinch is being felt globally across all sectors and industries. Particular focus is needed in ease of doing business, attracting and facilitating investment, both local and foreign, assistance to existing business to reach their potential, and availability of credit. Some of the macroeconomic indicators needs to be closely watched, such as foreign currency earning, RMG export, and balance of payment situation. As the business community, we are closely monitoring the situation. We hope that the government will be able to address these issues through robust monetary and fiscal policy measures relating to currency fluctuation, interest rate, inflation, GDP growth, and employment. I want to introduce the Chamber briefly prior to handing over the floor back. The NCCI provides support to its members to facilitate growth and increase market share. We design specific programs for our members and facilitate business meetings. Furthermore, we aspire to build coalition amongst the Nordic businesses operating in Bangladesh to address global and company-specific agendas. Through NCCI, we build partnerships with stakeholders, discussing and exchanging views on business conditions to address issues affecting our members. Additionally, we aspire to create value for all our Nordic investors and stakeholders alike. Moreover, we try to work as a contact point for the Nordic businesses and support Nordic investments here. Stemming from our strong Nordic value base, sustainability and social responsibility have always been at our core. The Chamber has also promoted strategic dialogues relating to sustainability in business, bringing together key stakeholders from all sectors. Previously, we held various events in association with the Nordic embassies in Bangladesh. The overwhelming positive response from all quarters made those events successful. Today's webinar is merely a continuation of that effort. The NCCI will continue to create an ecosystem which will facilitate much needed conversation and be beneficial for our members. I hope everyone in attendance will derive value from this session, and I'm looking forward to a lively moderated questions and answers session. On behalf of the Executive Committee of the Nordic Chamber of Commerce and Industry, I, Tarin Aman, as the President of the Chamber, welcome you to this webinar. I implore you to follow us on Facebook and LinkedIn to stay up to date about our upcoming events of the Chamber and look forward to your participation. Hope you all enjoyed this information session. Thank you. Back to you, Mashur.
Thank you very much, Tarin Bhai, for your introduction and welcome address. Before I move on to Asif, the main star of the show today, I want to briefly introduce him. Asif Khan is the co-founder of Edge Research and Consulting Limited and Edge Asset Management Company Limited. Edge Research is an investment research provider to international investment funds, commercial banks, DFIs, and others. Edge Asset Management is one of the country's best performing fund managers in Bangladesh, catering to both retail and institutional clients. Prior to joining Edge, Asif worked in buy and sell side equity research roles for companies out of USA and UK. Asif is a founder director of the CFA Society in Bangladesh and dedicates a lot of his time volunteering. I am proud to say that Asif agreed to host this webinar session for us at the first time we spoke, and this has become a reality today, considering the pandemic and his busy schedule. He has been instrumental in me understanding the markets better and the macroeconomic trends. So it's with great privilege that I introduce him. Asif, over to you for the session.
Thank you, Tarin Bhai, for your speech, and also Mashur for the introduction. Before I kind of go into my presentation slide, can you confirm that you can hear me properly?
Yes.
Yes.
Okay. Yes. Sure. And also, is the screen visible?
Yes.
Yes.
Okay. Perfect. Thank you. So, so basically, to start off, I am not a trained economist. I'm not a policy expert as well, but here I am trying to talk about the macroeconomic condition and outlook of Bangladesh. But as you heard from my background, it's actually in the financial markets. So primarily equities, but also fixed income and early stage companies, which we commonly known as startups. But interestingly, people like me who follow the markets and who have to follow the companies that are listed in the stock exchange, we actually have to closely follow the macroeconomy. And from a very practical perspective, because it has implication for my and our day-to-day activities. So what my aim is to, yes, obviously give some context, which is the more conventional way of looking at the economy, but add a few different perspectives, which I think would not be available elsewhere. And that perspective is, number one, having a bottom-up look to try to create a picture of the economy from granular company level data. And also the other one is having some unique perspectives on some thematic ideas. So I'm just going to introduce that. And finally, I would just say that what I have done here is a slide deck. So sometimes when looked at information visually, it gives some different perspectives as well. So I'll just start on. And my thinking is that I'm just trying to breeze through the slides in about 20-30 minutes, and then we can get into the Q&A sessions if that's all right. So obviously, all discussion of the economy starts with GDP growth rate. This metric is useful because it kind of summarizes everything in one number. But obviously, it has its all unique challenges. People commonly say that number can be manipulated. It has other biases, the way it's being calculated. But in any case, we'll start off here. If you look at the growth rate, right? If you look at the government estimates of growth, FY20 5.2%, FY21, which we just completed, the government predicted that it's going to be slightly above 6%, and expectation for the next fiscal year is 7.2. And if I look at the other agencies that have reported on the growth, ADB numbers are very similar to Bangladesh government, but World Bank and IMF numbers are a bit lower, especially for FY20 and FY21. And usually what the trend we have seen is the World Bank numbers are the most conservative amongst the different agencies. Now, for our understanding, or if I were to guess, right, 5-6% growth in FY20 or 21 does look quite a bit optimistic, whereas 2.5 to 3.6 also looks a little bit pessimistic. So we probably stand somewhere in between. But the real truth is, at edge, or the way I look at economy, I actually don't really follow the GDP growth rate number that much. I look at other indicators, like I mentioned, some bottom-up indicators to kind of paint a picture. Just confirming, is my voice clear?
Yes, it is.
Okay, there seems to be a little bit of a background noise, so that's checking up. So, anyways, so we're going to go into that. So first thing I'm going to look into is a few slides on the COVID situation, because everything about the economic outlook and what we have seen in the last 12 months or so is linked to COVID, right? So on this slide, the top left, the left chart, it's how the deaths and new cases have evolved. And clearly, we are in our second wave, so no new information there. And the second wave has been worse than the first wave in terms of the number of new cases and deaths. Now, the interesting bit is the slide on the right side. Even though the absolute number of deaths and cases have gone up, there's a very clear difference in how the deaths are spread around across the country. So this right slide is a percentage chart. So what we can see is that the share of deaths of other districts have actually gone up. In the first wave, actually this wasn't the case. So this is the difference in this second wave, which impacts the outskirts more than the Dhaka. It doesn't mean that Dhaka is not impacted. It is, but not to the extent we have seen before. The second part we are going to move on is the vaccine situation. So I think a lot of these things are familiar to you all, but just kind of going to quickly go over. After the few initial shipments, there was a long lull in the sense that we weren't getting any more vaccines, but fortunately the shipments have started to arrive. From the newspaper media, we have actually calculated how much has already arrived and how much is expected to come. So that's in this table, and it's roughly around 30 million doses or so. I think that's the ballpark number. And I was also checking how much of our population has been vaccinated. I think roughly it's about 2.83%. And if we look at regional countries, I think only Sri Lanka and India are ahead of us. Pakistan is actually largely similar to ours, so not that different. It's clear that I think it's going to take us a fair bit of time to reach a large percentage of the population so that we go back to normalcy broadly. But the government's estimate is that within a year, we should actually vaccinate a large part of the population. This is a very interesting chart, and this is the thematic kind of perspective that I wish to bring in parts of this presentation. How people have been reacting to COVID. So anecdotal evidence and also how financial markets have reacted to COVID is actually quite similar. And it's if we use our common sense as well, it's kind of same. And so here we have two lines. One is the infection rates. Instead of absolute numbers, we took like the percentage positive, which for Bangladesh is probably a better indicator than new cases, and probably even a better indicator than deaths. And the green chart is how the stock index has performed. So in the first wave that started like last year in March or so, the stock market was actually quite weak. So COVID actually had quite a significant negative impact on the market. In the second wave, which we can kind of say from late February till April 21, that's how the positivity rate kind of spiked in 2021. That time as well, we saw the stock market take a hit, but it wasn't as big as the impact we saw in the first wave. And the interesting part is the third. So I kind of broke it out into two parts. Some people call the second and the third the same. But if you look at the positivity rate, the wave of lockdowns actually did work. So positivity rate fell to high single digits by May. And then the government kind of came up with the new wave of lockdown just before the current Eid. But here, if you look at how the rate has gone up, but the index, the stock market actually has absolutely no impact. Now, the interpretation of this, you can kind of do it in a number of different ways. One, people have some sense of the worst case scenario, the mortality rates of COVID. and they are not as worried, especially the low-income segment, that for them, not working is a big problem because they earn each day. That's one part. The other part is the market may have been able to understand that, okay, this problem is maybe a 1-year problem or so, and very likely the data on vaccines that we have seen globally, that it seems to work. So countries which have been able to vaccinate a large part of the population, they have actually seen impact in number of cases coming down. So maybe they are discounting this period, but this is not just the financial market. We see this evidence talking to small business owners as well. For them, as long as there is no lockdown, they're not afraid, they're going to go to work. Okay. All right. So these 3 slides are obviously on the COVID side. We're going to move on to a number of economic indicators, which are more faster indicators. We can get them on a monthly basis to draw a picture of how the economy has fared until now, and which gives us some color into how it may look in the next 6 months or next 12 months or so. So the first one is V80 collection. This is a proxy of consumer spending. And I think these indicators, you can think from this perspective of a macroeconomic equation where GDP can be broken down into consumption, investment, government spending, and net exports. And consumption typically is the largest part of that GDP breakdown. It's about 70% for most of the economies, including Bangladesh. So for us, we take a lot of, put a lot of importance to consumption data. And if you look at VAT numbers, I think the impressive thing here is that the way we are portraying this is it's interesting. You can compare year over year, and you can adjust for seasonality. So VAT has been growing year over year. I think that's a good strong indicator, and also suggests that the fact that the economy opened up from last June or so onwards, all the way up till February, that really helped in getting the economy active. The other data, which is not on this slide, is just appeared last week or so, which is on the tax revenue by NBR. I think the FY21 number had a 15% growth, which also I would say is quite impressive, considering the pandemic period that has been coming on and off. Okay, the next chart is credit card spending. This one has seen a major growth. Obviously, we have to take with a pinch of salt because credit card penetration is low. So it's not just indicating economic activity. It could be just a shift of spending from cash to a more digitized model. And I think that probably explains a large part of the growth that we see here. That 2021 numbers are way above 2019 or 2020. Moving on, this is the ADP expenditure by the government. This is one of the areas where we are lagging behind in terms of, so the G component of the GDP composition, that's the one that has been lagging behind. Obviously, infra projects and some of the government projects, they are impacted during the pandemic. That's definitely one of the explanation. So this would be one of the weak areas. I'll just move on. This one is electricity consumption, and for us, the way we look at this data is, see, the residential demand for electricity, it's not cyclical. Other than the seasonality aspect, if we adjust for seasonality, that summer months will be higher and winter months will be consumption will be lower. It doesn't really move over much. So any delta in terms of electricity consumption likely coming from industrialization or industrial activity. And here we see a very positive indication that in 2021 per se, for example, that the numbers have been quite a bit higher. And in fact, some of the months like March and April, they are substantially higher than the previous years. So we do have a few explanations for this, that how come electricity generation is so much higher. Like one of the things that did happen is the factories have all come online in the last 6, 7, 8 months or so. The other part is we felt that some of the energy intensive industries have seen a major boost in demand. We'll talk about the industrial performances later on, and we'll give some color on which are these industries that may have driven the growth in March and April. But overall, this data is showing that there is activity growth. Capital machinery import, this is the one that, just like government expenditure, has been lagging. It is below 2018 numbers, but slightly above 2019. But broadly, I would say it's still on the weak side. And I think it's quite logical, given that these on and off bouts of lockdowns, the uncertainty that still remains, it is difficult for capex planning. And again, I will kind of elaborate a little bit on the banking sector and also the post-COVID economic condition, and try to tie up the capital machinery import data and outlook. So here we move on from the activity indicator. So just to summarize, if you look at the C plus G plus I plus NX equation, consumption, I think, has been fairly impressive. It has bounced back quite strongly from the data and indicators we look at. Government spending has been lagging. The private sector investment has been lagging. I mentioned that I will give some more color on this. Now we go into the net exports part, which is the external side. So in the initial period, which is like the post-COVID period in 2020, the trade balance, which is basically export minus imports, actually improved quite substantially. So export bounced back fairly fast, driven by ready-made garments. Imports continued to be weak back in the months of June, July, August, that period. Largely why? Because at that time, commodity prices were fairly soft. They were weak. And in the situation where private sector investments are low, capital machinery imports are also low. So imports are low. But as the economic activity kind of picked up, what we had seen is imports also picked up. The investment part of the imports still not as strong, but the consumption part of imports have gone up. And here also we have seen a big change in the commodity prices globally. So all sorts of commodity prices have gone up, including the ones that we import. So terms of trade for our economy deteriorated and imports picked up. So the balance of trade, the trade balance actually deteriorated from that perspective. And as far as export is concerned, like I mentioned, June, July, August, strong months. But towards the winter period, when the developed economies saw the second wave of COVID, our exports weakened. But from that point onwards, as summer came and also as US and EU kind of rolled out their vaccinations and they have opened up, we have seen a strong rebound. And I was also reading that some orders from, let's say, India and some other neighboring countries have been coming to Bangladesh. So that's a fairly positive side. Obviously, we can argue into the more granular level data on what sort of margins are available in garments. That's a different question altogether. But I'm just talking from a pure demand perspective. Moving on, if we add the remittances to the trade balance, we look at that's kind of simplistically, that's current account. We have seen large surpluses last year and some parts of largely up to last year. But this year, as the economic activity increased, imports increased, we saw current accounts going to deficit. So a soft deficit is not a problem. I think the deficit part is quite within control. So that's not an issue. But I'll just take a little bit of time on the remittances side, because if you look at the headline remittance numbers, they have been super strong, like 40–50% growth. And remittances have clearly helped our foreign exchange side, the external side, and the currency side. Now, the question is why? Because prior to that, everybody predicted remittances will take a hit. And logically, that should have happened. So our hypothesis, and I say hypothesis is because it's still not 100% proven, but I think by now it's almost clear, is a lot of the hundi inflows, the informal inflows actually shifted to the formal side. So which explains why the remittances have gone up in the official numbers. And obviously you have to remember that the government gives a 2% incentive on remittances. So that explains why remittances have gone up substantially. So I don't think the actual true remittances have increased substantially. So actual true remittances is formal plus informal. So I don't think that has happened. I wouldn't be able to find any logical explanation for that as well. But in any case, it still has helped us. And if we look at the this chart, which is on the FX reserves, it's a little bit complicated, but just the important thing is that the green line, as long as it's above 0, it means that your reserves are going up on a net basis each month. And broadly, that green line has been above the 0 line, which means that the combination of current account flows and capital account have been net positive and reserves have built up. So right now, I think reserve position is around $46 billion. And if I kind of look at this chart, that reserve position implies almost 9 months of import cover. So that's a very good, solid position to remain in. I think unlike some of the neighboring countries like Pakistan or Sri Lanka, which are struggling on the external side, Bangladesh has a good, strong buffer. And if you look at the red dotted line, that's the exchange rate that has been very, very stable. We'll talk about the exchange rate policy in a while when we look into the monetary policy slides. And also when we, at the end of the presentation, I'll try to give some outlook on these things on both economic activity, on the exchange rate side, and also on the interest rate side. So just moving on, now we come to the third part of the presentation, which is the monetary policy and the interest rate cycle. So because we have covered the activity side, we have covered the external side. So on the interest rate side, clearly, I think all of you are, it's clear that interest rates have come down dramatically. In this chart, we show the 364-day government bond yields, which have come to like almost single digit. Even the 5-year bond yield is about right now around 4% or so. That's the red line. And if you look at the historical average, right, the 5-year yield, it's around 7-8% or so. It's like a 400 basis points reduction in yields. Now, if I try to understand what has happened, why has interest rates come down so dramatically in the country? It's actually both demand side factors and supply side factors. So I'll touch upon the supply side first. One is in a situation of economic shock, just like COVID-19, all governments will want to stimulate the economy. And one of the methods is actually printing money or having a loose monetary policy. And Bangladesh Bank has actually done exactly that. They have cut their policy rates, they have cut their reserve requirements, and they have been using open market operations to kind of ensure that there's plenty of liquidity in the system and interest rates are extremely low. And that has worked. So Bangladesh Bank, I would say, has done a great job in from that perspective. And the other one is going back to the exchange rate policy. Is Bangladesh has a very interesting exchange rate policy in the sense that we try to keep exchange rates stable. So even when there is a strong increase in FX reserves, we want to keep the exchange rate stable. And in the opposite periods, when there's a pressure on our reserves, we want to keep the exchange rate stable. And this, knowingly or unknowingly, has a huge impact on the monetary policy. Because the only way a central bank can do this, especially when my dollar supply is going up, the dollar reserve is going up, is by buying surplus dollars from the economy. So if it buys the surplus dollars from the commercial banks and injects Bangladeshi taka, the supply of taka automatically goes up. So imagine the central bank is running a loose monetary policy, and then on top of that, it's buying dollars from the commercial banks, which adds to the money supply even more. And the flip side also happens, that when times are tough, when exchange rate when the foreign exchange reserves is under pressure, the central bank does the opposite, and usually at those times interest rates are high, and actually once we mop up BDT liquidity, it gets even higher. So we end up with a liquidity crisis. And if you look at 2018, parts of 2019, that's where we were as an economy. We were having quite a bit of liquidity crisis in the economy and the banking sector. The other part in this chart is the commodity price index. That commodity prices from 2020, late 2020, actually started going up, but it didn't have an adverse impact on the interest rate cycle. And that I explain using the demand side factors, because money supply has gone up, but demand has also come down. So, and for that, I'll just move on to the next slide. M2 is the supply of money that has been growing up a little bit from 2018 levels, but the credit growth, which is the private sector credit growth in particular, from 2017 onwards, it has been declining. And COVID in particular has made it come down even more. So if you add the two, that supply has gone up, demand has come down, that explains why we have ended up with so much liquidity, even in a period when commodity prices have actually gone up. So I'll just move forward. This slide is another, again, something we have done at Edge. We basically looked at a few key sectors from Dhaka Stock Exchange, identified some companies within those sectors, and then they tracked their capex to sales ratios, because looking at absolute numbers of capex actually can be misleading. So what we have seen is it's not just private sector credit for the economy as a whole, but if you look at how credit capex cycle has evolved, it has been broadly coming down. Other than like sectors like automobiles, which is more or less flattish, most of the other sectors have seen capex come down. And the real question I think is why private sector credit growth has been slow. Why has it been low for the last few years? And it's not just COVID, it's pre-COVID as well. Obviously, COVID brings on new challenges. Banks are not interested to lend at these uncertain times. Economic outlook is not very clear. So even from the demand side, business people are not willing to go for a lot of capex. But I think I want to add a few new perspectives here. One is, if I look at corporate Bangladesh, not the multinationals, but corporate Bangladesh, my understanding is that it has gone through a major credit cycle, especially from 2000 to 2010, that period, and even in the years after that. So a lot of them have high levels of debt. So we actually need a deleveraging cycle for them to get back to a more stronger, healthy stance. The other thing related is the transmission channel of credit is banking sector. So banking sector also has gone through a similar sort of a cycle where we had periods of very strong credit growth and a lot of NPL or non-performing loan build-up. And these banks need to clean up their balance sheets before they become comfortable enough to go for high levels of credit disbursement again. So in addition to COVID, I think these are 2 points that I would like to make. I'm just going to move on. This slide just looks at what are the causes of the money supply growth. I don't think it's very relevant here. We can just skip that. And this one looks at the relationship between the interest rates and equity markets. Clearly, by theory, they should be inversely related, that interest rates come down, stock market should go up. And that's also actually what has happened. The data also shows that it's a very clear combination or clear relation. And I think this kind of explains why globally, and it's not just in Bangladesh, it's actually the entire world, why even when you have weaknesses in the economy or the economic numbers are not strong, the stock markets have been like going through the roof broadly. And it's the monetary stimulus and the record low interest rates that largely explains why this has happened. This slide we will skip over. Inflation, largely around 5.5%. This is broadly what the government targets. Obviously, this is a very sensitive data point. A lot of people believe that the numbers are underreported. Well, I really can't comment on that, but my sense is that depending on how you calculate inflation, it's not significantly different from what the government reports. That's kind of my guess. But there are certain pockets of the economy where inflation is actually higher, especially for the lower income group. I have seen that inflation can be actually quite significant. And unfortunately, that's the segment that's the most vulnerable in the from any sorts of economic crisis, and particularly the COVID crisis. I'll just move on here. A quick slide on the fiscal side. I think Mr. President mentioned about the budget that sort of came up a few days back. So in terms of the budget, I think in terms of the size, it's around 20% of GDP. That's kind of lower than what most of the countries of the world have. But obviously, we have to remember that this is because our tax base is also lower, typically high single digit, 9-10% or so. And there's also an implementation challenge. Now, the big two themes that we have seen in the budget, one is on the corporate tax rate. We have seen that tax rates have been reduced across the board, I think, for both listed companies and unlisted companies. And the other one is a priority towards Make in Bangladesh. So in terms of giving tax holidays for certain sectors like consumer electronics, cars, etc., etc. But it's also a fair bit of protectionism on the duty side. Now, this one, the second part, is criticized by certain economists. who believe that we protect our companies too much. But obviously, I'm not an expert on that side. You can argue both again, both in both sides as well. But if I look at the other key things that I think criticisms that have come, one of them is the expenditure on healthcare. So the counterpoint to that, the low expenditure on healthcare is that the implementation or expenditure capability is low. But again, you have to remember that if we can't spend the right amount of money on key areas like health and education, that's a problem. We just can't allocate low because we don't have capabilities or capacity. But in general, I think one of the big points I want to make, for a long period, Bangladesh actually had fiscally, we were fairly conservative, and that has paid off, which is why our debt levels, both public debt, external debt levels, are quite a bit lower than our neighboring countries. And it allows us to have deal with economic shocks better. And that's why I say that compared to some of our peer nations, we are probably in a slightly better position. Okay, and then I'm coming to the almost the last final parts of the presentation. This is a quick snapshot. Again, you drawing on data from the stock market and companies listed in the stock market to see how they have performed, and can we draw a picture of the economic condition from the actual numbers they're reporting. So what we have done, we have broken down them into sectors: telecom, pharma, consumer goods, construction material, automobiles, financials, right? The first two columns are the stock market returns. The first is the last 1 month, and then the year to date. So firstly, the stock market has been strong. The market has returned about 18% for the year. And if you look at most of these sectors, telecom, positive return; pharmaceuticals, most of them positive return; consumer goods, most of them positive return; construction material clearly has outperformed quite significantly. So the stock market has done quite well. Now, the question is that sometimes that's backed by logic, which means actual business activity. Sometimes it's due to interest rate cycle. Sometimes it's a combination of the two. So we're going to look at revenue next. Now, if I look at revenue, what we have here is the January to March quarter, which is the last reported quarter for these companies. And we can look at both year over year and quarter over quarter. So for telecom, I think it's almost flat year over year, but quarter over quarter, slightly better. For pharma, we are seeing some sort of growth across the board. I think mid to high single digit growth. Consumer goods have done quite well, except for one or two companies which have been underperforming. Most of them have seen double-digit top-line growth year over year. So that's a strong sign, and kind of reconfirms my earlier points that from a consumption standpoint, despite the COVID pandemic, despite all the challenges, consumption for the economy has been fairly resilient as a whole. Now, again, if you break that down into higher income groups, medium income groups, and lower income groups, you can see maybe a very stark difference in the picture. But overall, it has not been that bad. The sector that is most interesting is the construction sector. And I kind of hinted at this one earlier. This sector, if you look at the revenue growth year over year, 30-40% in certain cases. So what really happened is when the economy opened up from the lockdown last year, we saw sectors like pharma do well, sectors like consumer goods do well, even telecom, which actually quickly rebounded compared to the pandemic quarters of, let's say, March, April, May, early June. They rebounded. But construction actually lagged in that period. So that lag effect actually came in early 2021. That's January to March and kind of April onwards. So for sectors like cement, sectors like steel, sectors like paints, there was a major growth in demand from both residential, real estate, and in government projects as well, all of which kind of came into full swing. And this is very interesting because if you look at the commodity price cycle, clinker prices have gone up, steel prices have gone up. So for all these companies, prices of products have gone up, yet demand has been strong. So again, if unfortunately we had that second wave of COVID, if that wave of COVID did not come, the economy, these indicators would have suggested that was on a fairly good path of recovery from based on this data. Now, given the current situation, and I'm going to talk a little bit on the current situation later, it's a little bit uncertain, but so far And obviously, the months of kind of the current months for construction are the lull periods. It's a rainy season, so it's not the strongest months in any case. So we'll have to wait and see. But I think this was something that really surprised me overall. The fact that revenue growth was so strong, and the ability that companies were able to kind of push on the prices to the customers. And if I look at the third part of the table, which is the gross margin, most of these have seen gross margins actually improve. I'm talking about the construction sector. For the financial sector, it's a kind of a mixed situation. This sector has not done that well. From a stock price perspective, some of them actually have gone up, but operating numbers, it's kind of mixed. A lot of performance has been driven by one-off stock market or bond market gains, not by core banking returns. And obviously, I mentioned that the asset quality of banks have been impacted by pandemic, and even pre-pandemic balance sheets were not the strongest in Bangladesh. And clearly, due to some of the measures by the central bank in relaxation on how bad loans are reported, I would say the current numbers being reported are not truly reflective of the reality. So just moving on, a few other slides, we can see how the revenue numbers have evolved in the last few years for the cyclicals and the medium cyclicals, and the less or non-cyclicals. So sectors like tobacco or pharma would be the low cyclicals, and sectors like steel, cement would be high cyclicals. So here also you can see how they have actually grown year over year. Clearly, the cyclicals have gone up quite substantially. And then even for the other ones, they are not negative. They are still in growth territory, but not maybe significantly higher. And then you can break down the cyclicals into other components, which is steel, cement, automobiles, consumer electronics. If you look at how the Q1 or Q2 numbers, again, a very sharp growth there onwards, and medium cyclicals kind of flat. Low cyclicals have been flattish, roughly. Now, kind of towards the end, this actually looks at some of the metrics of the economy from a longer horizon. Like some of the things we talk about is how resilient our economy is, and we kind of draw parallels. The last time we talked about resiliency was the global financial crisis. In that period, Bangladesh economy kind of had almost no impact whatsoever. Now, from that point onwards, like 10 years, 10, 11 years fast forward, obviously the economy today is much more integrated with the rest of the world, and a pandemic like COVID-19 is a very different pandemic from something like global financial crisis. So if I compare the current situation with debt, here, yes, clearly there has been some impacts, like exports, for example, it shrunk in 2020. Banking transactions, 2020, it shrunk quite significantly. And real GDP growth, what I showed in the first slide, it came down. But even for this time as well, all these indicators have shown a very strong rebound. Like exports, if I do calendar year comparison, 2020, so fiscal year comparison, like 2021 had a strong rebound. It hasn't yet touched upon the 2019 numbers, but very, very strong rebound in general. Remittances obviously has no adverse impact. The other one is banking transactions. It has gone back to pre-pandemic levels in like a few months, like in June, July, August, like very swiftly it went back to pre-pandemic levels. And real GDP growth, obviously, my guess is we are not going back to the 6-7% growth rates, but my sense is 3-4%. I think that's more like a realistic number. And for the current year, obviously, once you kind of come back from a tough year, the growth number is higher, and that's what even IMF, World Bank, they are also projecting. But for the few next years, I think we have to draw a few different scenarios, and I'm just going to talk about that. This one is a slide on commodity prices and how Bangladesh has performed. This is also a thematic research we have done, and basically we have seen that our financial markets, especially equity markets, have typically perform very strongly when global economy goes through a crisis. And the way we have linked this up is every time the global economy goes through any crisis, which is global financial crisis or COVID, our central bank goes for loose monetary policy. That's one. So there's a lot of stimulus on the monetary side. Number two is the global commodity prices come down. And as a country, we are net importers. So our terms of trade import, we start running balance of payment surpluses because remittances are fairly resilient. Our garments exports have been fairly resilient, and that also adds up to the stimulus in the economy. And we end up having a lot of FX reserves growth. We end up seeing low interest rates. We end up seeing initially equity market rally, and later due to the low interest rates, you kind of see a real economic activity getting stimulated as well. So that's that. So just to wrap up, like, because the discussion is about the outlook. Most of what I discuss is what has happened, but I am drawing upon what has happened to paint a picture for the future. So first of all, in terms of the easy ones, interest rates, I think it's quite clear they're going to remain low. And because a lot of it depends on the central bank, the clear guidance is that the central bank is not going to become conservative. One, because inflation has not gone up significantly, not a big risk there. And number two, my external side is strong. If any of these two were weak, the central bank's stance could have been different. But because we are in a comfortable position, and the priority right now is to jumpstart the economy, keep kind of economy strong and afloat, I don't see a risk of interest rates going up in the next 1 year or so. Maybe it's going to go up a little bit because we are at a very extraordinarily low rate environment, but not significantly higher. In terms of exchange rates, yes, the current account surpluses are no longer there. Maybe balance of payment surpluses can move away at some point. But given that we have a substantial buffer of $46 billion of reserve, 9 months of cover, and the central bank's policy is to maintain the exchange rate stability, I think you should expect exchange rates to be around this level for some time. And if there is any depreciation, it's going to be very slow and gradual, given the current context. Unless like things change dramatically, we shouldn't be much concerned about exchange rate as well. So these are two things which are very, very clear. The challenging part is obviously economic activity, because we have to draw on multiple scenarios. So for simplicity's sake, let's just say we have two scenarios. Scenario one is where the economy comes out of the current lockdown and basically rolls out vaccines quite fast. And then within a year or so, we kind of get most of our population vaccinated. And that helps kind of control COVID substantially. So that's, I think, the bull case in general. And the bear case is where the vaccine supplies or the vaccine distribution is not the best. And obviously, there are these questions about the different types of vaccines and how strong and how good they are on the Delta variant. So especially with the Chinese vaccine, research is still being done on how the efficacy levels are globally. So there's a little bit of uncertainty. But so that's the number two scenario. So in number one, on the bull case thing, my view is that from what we have seen so far, as long as we can vaccinate a good percentage of the population, and also remember that if you look at Dhaka versus rest of the world, rest of Bangladesh, the COVID infection rate, one thing could be that the antibody level in Dhaka was higher. That could also explain why Dhaka was relatively less impacted. So that sort of herd immunity could also help in addition to the vaccine rollout. So if I understand from that point onwards, I think 1 year from now, we should be in a good position. And if there are no substantial lockdowns, the economy should bounce back and in the manner we had seen in the last 9 months to 12 months or so. In the second part, obviously, if there's delay in vaccination rollouts and if these lockdowns are too frequent, that has some second order, third order impacts and some structural challenges for the economy. So that could be a little bit more difficult. And just to kind of quick, and I'm not sure how much time we have, but I'm just going to try to wrap up right now. In terms of some of the challenges we see right now for the economy and also the post-COVID challenges. For now, one of the major challenges is credit access. Credit growth, I mentioned, it's extremely low, and especially credit access to the small businesses. That's a big challenge. There is a policy problem here. Like, I'm not saying that the policy is wrong. I'm just saying that it's extremely difficult to give credit in times where risk premiums have gone up. Nobody wants to give loans in general, and then the ones that need credit most are the most vulnerable. That's the problem. That's a practical problem, and it's not easy to solve. So that is one problem, and that's the segment of the population, especially the lower income segment. They have been impacted the most. So for them, the first lockdown, yes, I can borrow some money, I can kind of survive with some borrowed money from friends, family, whatnot. But as long as these lockdowns continue, it becomes extremely difficult. So that's one of the problems that is clearly there. Vaccination, I already mentioned that it was a problem. Now it has been somewhat solved. I think vaccine rollout is happening quite rapidly right now. But the other part of the equation is, once we put COVID behind, what are the issues there? And I think the biggest issue for Bangladesh economy then is the banking sector, because still now we clearly don't have the a measure of what sort of impairment of bank balance sheets have happened. So this was an area of weakness even before COVID, and clearly COVID has impact. So we will only kind of see the clear picture maybe 2022, 2023, when the relaxations on loan moratoriums, when the rescheduling facilities start going away. So that's going to be one of the major issues for the economy, because if, as long as we can avoid a liquidity crisis or a credit crisis, I think Bangladesh economy is still on a strong path. So that's kind of everything from my side. And finally, from my side, this is a newsletter that we have. It's free for everyone to subscribe. We basically send out daily news summaries, so anyone can subscribe. You can share it to your colleagues and friends. So you just go to this email and put this website and put your email address. And the last part is that you can contact me at my email address. I'm showing that on the screen for any need. I'll just end there and try to answer any questions that you have.
Thank you, Asif, for your presentation. We have thoroughly enjoyed it. I personally thoroughly enjoyed it. And I'd like to open up the floor for questions if there are any. You can write it on the chat box or raise a hand, and we can take it from there.
Mashur, I would like to start off, get the ball rolling on the Q&A, if I may.
Please.
Okay. Asif, the presentation was very thorough and very informative. Thank you so much. I want to comment on something, and I would really appreciate if you can shed some light on it. The current lockdown that we are going through right now, I strongly feel that its impact on export revenue is going to be different from how it was in the past lockdowns. And we do understand that, for situations like this, we need to have a lockdown which is very strict, and that is the only option we have to curb the virus. But the reason I say that is because in the past lockdowns, export factories were open. So there was a revenue generation going on, export revenue. As of right now, everything is shut down. Everything is shut down. So there would be a gap in export revenue. And it may even have a short-term domino effect in other areas. So what are your thoughts on that?
So I think in the first part of the question, that this one is different from the last lockdown, and even the second that we had in February-March period. I agree with that. And we already saw some of the comments in the newspapers that this is a peak season. A lot of orders were coming through. So when buyers see some sort of an announcement of a lockdown that impacts factories, is going to have an impact. So I think on that note, I totally agree with you. No differences. But in terms of from tackling this part from a policy perspective from the government, I think if I put myself in the spot of the government, and I do also understand why this has happened. So clearly, this second lockdown had to be. This couldn't continue for a long time. So what we had done at Edge, so we looked at the lockdown that we had from late February to March, and then compared to this one. So in this third lockdown, I think the key is that it continued for only 2 weeks, and then you had to open the economy up for Eid. Whereas in that one, you kind of had it prolonged for third week or fourth week, kind of like that. And we started seeing numbers kind of like in terms of infections come down in that third, fourth week. This time, the first 2 weeks, the death rate or the infection rate, it did not go up from the peak, like around 30% infection rate and like 180 to 200 deaths per day. But it did not come down as well. So that's the challenge. Because of the fact that we had to open up for Eid, So government had to overcompensate and saying that, okay, I know there's going to be a spike in COVID, I know there's going to be a spike in deaths, but to overcompensate, let's just shut down everything. But obviously, this is such a major trade-off, the economy versus lives. It's you can argue on both sides very clearly. So I think once we have this phase in a week or so, I think both the business community, the government will be in constant communication and see that if there's a way to kind of open up some of the sectors, some of the industries, because you can't close it down for a long period. I think that's kind of my understanding.
No, absolutely. No, I completely understand that, there are times when you are left with only one option, the strict lockdown, complete shutdown, and that is the only way to curb the virus. And I totally agree with that. But do you think this gap of revenue, export revenue, that's going to come? Obviously, because all the export factories are shut down, and we do have a lot of members who are big buyers in RNG sectors as well. So do you think this will have some domino effect in our economy or in our financial flow, fund flow?
So I think, so first of all, I would kind of admit that I'm not an expert on this exactly from the buyer's perspective, because I think a lot of it will depend on the buyer psychology, the big ready-made garments buyers, how they think. But if you kind of break down the question into a different parts, right? For the output lost in the 2 weeks, I think from a overall economic perspective, I don't think it's massive. It's from that two weeks problem. The problem it causes is the uncertainty, because it brings up a precedence where if you have future rises in cases, that can lead to lockdowns for the factories, and that's where the buyer psychology kind of comes in, because then if that uncertainty is there, it's not about whether it's going to happen or not. They would have to think for other options of sourcing. So I think what is very important is at least to have some clarity on whether this is a one-off thing for only now, or this is going to be something that we may see in the future. That's the way I'm reading into this. If it's some sort of a one-off thing and you have some strong vaccine rollouts, for example, if you prioritize like ready-made garments workers, for example, just like university students, right? In terms of vaccine rollout, then you kind of sort of mitigate and reduce that uncertainty to some bit. Because even now, I think Bangladesh would be a good destination to source from, as long as you can kind of solve the uncertainty bits.
Thank you, Asif.
Yeah.
Thank you very much, Asif. Any other questions? Well, while we wait, Asif, I had a quick one. The informal economy has suffered a lot. We get to have data of the formal economy, data being published by Bangladesh Bank and other institutions, but the informal economy is also being hurt massively due to this lockdown. And I'm pretty sure that is also going to impact overall economic activity and the data coming out. So your comments on that, maybe?
So see, again, so you tackle it in two ways. One is from your common sense and logic, right? The informal economy is the economy where the lower income, the day workers, the day laborers are in. And as lockdowns are concerned, they are the worst hit. They are the worst hit in general. They are in debt, they're in difficulties. So there is no question about that, right? But what we had done last year is try to understand the informal economy activity using proxy economic indicators. So one of them is voice usage for mobile phones. We look at the revenues of companies like Grameenphone and Robi, because mobile phone usage on the voice side is almost a necessity. The other is mobile financial services like bKash and Nagad and those. So what we had seen from activity indicators is that when economy opened up, very swift growth in those activity indicators in both like voice data, voice usage. Yes, voice had some lag effects, some weaknesses there, but in MFS there was a very swift growth. Again, you have to look at the data with a pinch of salt, because there's a lot of financial inclusion on the MFS side that's happening. There's a lot of digitization, so it's not just the lower income group, but that still you can kind of say that has happened. Now, my worry is that when you have a 2-3 months of lockdown, you have that first wave of problem for the informal sector and the lower income group. You can kind of tackle that. You can, like I said, you borrow, you kind of take credit, you buy food on credit, you buy raw materials on credit, right? But the second, third waves, that becomes difficult. And I think the second or the second, third or second wave, whichever way you define this, right? Data by the development institutions like BRAC or whoever is work, that's only going to start coming out now. This is going to look quite a bit bad. And I think this is one area where I think we have a weakness as a country. We can afford to spend more fiscally, outright grants to that lower income segment, like clearly, not debt, not loans, like you just go for cash transfers. The challenge is basically identifying the needy people and distributing that. I think there we still have challenges. Like even from a grassroots level, you cannot make a database of the people who are the right people. So that has been a clear challenge, and that has been mentioned by big NGOs as well. So I completely agree that the informal sector is in a much more difficult state, and it hurts them quite a bit, the lockdowns.
And also the government spending side, I feel the government needs to be very proactive and make sure that whatever is being kind of earmarked for government spending, especially in the development projects areas, are actually spent, given that lockdowns are occurring and the regular economic activities are taking a hit, right? Infrastructure projects and other investments, right?
I totally agree with you. And this is another point I wanted to mention, that in this second, third lockdown, one of the key commentaries from our side to our clients was that with the experience of the first, the corporate sector has actually learned how to work within the pandemic. So in terms of the supply chain challenges, like excluding the global challenges, like the global challenges are different, right? But how within Bangladesh, how you kind of stock up, you keep extra inventory for the import dependent ones, how you distribute, like that, they have become a well-oiled machine. They have learned how to work from home. Even those running factories, we have seen how they have adopted the standard operating best practices in terms of the factory operations and whatnot. So our call was that as long as you don't have lockdowns, but you have increased infection rates, you don't have to worry about loss of output, because companies will navigate that. That's clearly. On the public side, at the government side, obviously for legitimate, for different types of reasons, right? It moves slower. The adaptation of technology is also slower. So that's not going to happen overnight, for sure. I think that's something we have to live with. But hopefully this experience will help us give more priority and kind of work on some of the weakness, almost from necessity. We have to kind of sort out some of the challenges, and especially the digitization side that we have to learn to work remotely. Yeah.
No. This I just wanted to thank Asif. It was a very interesting informatics and all that he used. I mean, the information, and I don't exactly have a question. I have to mull on that. I have to think about it a little before I can come up with any direct questions. Thanks.
Thank you.
No, I can join this. Very, very informative, and especially learned as working for GP that you massively look into mobile data usage and how it's done. That's good for your forecast. Very interesting. Can learn from this. So very good. No, very insightful.
Thank you, gents. I think one question we have in chat is Mr. Rashid. His question is, do we have any data on how our small economy like light engineering, leather and footwear, etc. suffers for this, and any monetary value? So I don't have a outright data on this, because this sector is not very well represented in the stock market. So the beauty of the stock market is I have a clear data set of publicly listed companies. On leather side, for the footwear retailers, like those who manufacture and retail, which would be your Bata and Apex, I think that's one of the sector which has been hurt significantly. So within the consumer goods sector, like you have different types, like you can classify the processed food. You can talk about like the health and wellness, like hair oil. This is the sector we saw that revenue has been very weak, and clearly because a lot of their sales are like in-store sales, and people not going out of their house means not using their shoes that often. Income impacts, which means that consumption power for some people have come down, and clearly if in lockdowns their sales kind of goes down to zero literally. So that sector from a local market standpoint has been clearly impacted. From an export side, I don't remember, I don't have the data right in front of me how leather exports have fared. I'm not 100% sure, but my sense is that with Europe opening up, US opening up, export side should probably do a little bit better than the domestic economy. A small economy like light engineering as well, I think I would classify this on the SME side. While I don't have a data point on this per se, one very interesting data I had, I tried to look it up, and obviously I'm going to share the slides with everyone so that because we had that comment as well. I'll try to add that slide and show. And that was from Bragg Bank, who have been tracking their SME clientels, and not just SME retail and corporate, how they have been taking the loan moratorium. So that's also indicates how the health of the clientele has been. So what we have seen is that a lot of these guys who are in light engineering and also in the trading business, which makes up bulk of SME, in 2020, actually the loan repayment characteristics had improved quite substantially. So my sense is that initially huge negative impact, but second half of 2020 probably they have bounced back. But again, now this second, third wave part, I think it does put them into difficulties with, especially if they have taken on new loans. There's a little bit of challenge there. For sure. I don't have any monetary data on the impact yet, but if I find something, I'm going to share that.
Thank you, Asif. Any other questions or comments from the attendees? How do you think Bangladesh is going to fare compared to other similar economies? So I think it's unfair to compare Bangladesh with India. A more able comparison would be Vietnam or some of the other ASEAN countries, and even maybe Pakistan and Sri Lanka. How do you think that is going to look in another 6 months to a year's time, especially for foreign investments coming in?
So if I compare with Pakistan and Sri Lanka, my sense is that we are in a much better position. And a lot of that has to do with legacy issues. And I kind of hinted at this, like the debt levels we have. Sometimes, say, if you have prior problems and you get hurt by a new problem, that kind of adds up to that. So both Pakistan and Sri Lanka, they had a balance of payments problem for a long time. A lot of debt from IMF and other sources, and also if you so that definitely puts them in a very difficult position. For Bangladesh, we don't have a major debt problem yet. Debt side is low. We don't have a major balance of payments problem at all. In fact, that's quite strong in general. So we are in a better position compared to them. So I think that's clear. Vietnam, on the other hand, is a different story altogether, because one, they have a very strong export engine. This engine has been working for quite some time. They have a strong export policy, and the switch over of manufacturing from China has benefited them significantly, not just because of the fact that their industrial policy has been very swift, strong, ease of doing business is, I would say, better than ours, but also because of the proximity and the language and cultural issues. I think for a Chinese businessman, it's much easier to go into Vietnam than to come to Bangladesh. If I were to guess, they would probably be doing much better than ours. And the last part is another thing that I have hinted. The banking sector for all these Asian economies is a huge part. Like if you go to the ASEAN countries, and 1997, they had a banking crisis. It took them a decade, more than decades, to kind of get out of that sort of banking crisis and clean up the economy and kind of start fresh, right? So for Thailand, Malaysia, Indonesia. Vietnam had a similar banking crisis as well. That happened after the Asian financial crisis, probably 2007, 8, 9, that sort of period. Like people lost trust in the currency. So they have passed that painful period. But if you compare that to Bangladesh, right, our banking sector never had a major crisis. And even when a few banks were in difficult state, the banking sector size as percentage of the economy was small. Now it's larger than before. It's not super large, but it's still larger than before. But we need to get out of this banking sector problem. So that's where Vietnam is ahead of us. They still have some problem. All of their banks are owned by the government largely, but I think they have addressed some of the pain points. They have set up a asset management company, which is for bad loans, like cleaning up the bank balance sheets, giving some confidence back to the people. So I think Vietnam is probably in a better position. Even how COVID was tackled in the first few waves, I think their responses were quite a bit better than ours.
Right. Well, it's 6:18 here in Dhaka, and I think we've covered the better part of an hour. Thanks to Asif for his wonderful presentation, very informative. I hope you all enjoyed the session and you derive a lot of usage from the information that has come about. He has promised to share his light with us, and additionally, I guess Labiba will share it with everyone present here. Without taking any more of your time, I would thank you all for joining this session, and I would implore you to continue to follow us, the NCCI pages on Facebook, LinkedIn, and Twitter for our upcoming events. If you run into any problems or have any concerns, feel free to contact us. We are always at your service. Stay safe, stay well. Good night, and enjoy your evening.
Thank
Thank
you
you very much.
Very good. Thank you.
Thank you. Thank you,
Thank
Asif.
you.